everybody, and welcome to the Brian Fultis Behavioral Finance Podcast. My name is Brian Fultis, and I am an associate professor of finance at Butler University in Indianapolis, Indiana, and my goal is to teach you about the areas of behavioral finance. Today's topic is talking about our heuristics and biases as they influence our financial decisions. So the financial impacts from some of these errors that we make with our decision making. So thanks everybody for watching. Hopefully you're enjoying the content so far. We come out with this every Tuesday, and I'm having fun doing this. Got my new office now that I'm excited about, and making our way through, trying to help people learn about behavioral finance. And if you haven't already, please make sure you like and subscribe. Would love to hear from you. And you can find me on Instagram or on, I think, any podcasts that are out there right now. I've linked myself up to as many as I could. So hopefully getting the word out about behavioral finance and learning a thing or two. So anyway, thanks again, everybody. And we're going to just go ahead and jump right into the content, as some of the stuff is going to overlap with the content that we had in the last 3 episodes, not directly, but just as a piggyback to it. So remember, our heuristics come from expectations that influence perceptions. So if most people are saying good things or bad things about a company, we're going to seek out that information that seeks to confirm what we want to know. So whether it's a company, or if you are what we call a perma bear or a perma bull, you're going to find the information that tries to confirm that. And of course, you know, some of these perma bears are going to be eventually right a lot of the time, and they paint a fairly convincing doom and gloom scenario. And I do think that some of the risks that we have out there are sometimes underweighted. But nevertheless, they've been wrong for the last 15 years. So if you're just going to stay in cash, then you've completely missed a tremendous bull run since 2008 or 2009. So anyway, we have to be careful on this information and understand that, hey, am I going down a confirmation bias rabbit hole, or is this something that is balancing me out? So when we talked about a couple of podcasts ago, this diversification heuristic. So this kind of comes to the buffet that we talked about, where you want a little bit of everything because you don't want to miss out or feel any regret around this. We also, in our retirement accounts, we also try to do the same thing. We tend to buy just a little bit of everything that's offered for the same reason that we don't want to miss out on the buffet. And but what ends up happening is our portfolio allocation is not essentially true to our own risk preferences or our risk tolerances. That's just basically going to be a random way that our retirement accounts have been laid out for us. So if our retirement accounts have mostly bonds in them, then, and I pick one of everything, well, then I'm going to have way too many bonds in my portfolio, you know, for being a 20-some-year-old who should be in stocks. You get the point. So what this is actually called, this diversification heuristic, is we call this naive diversification. And says that we tend to allocate 1 divided by n in our portfolio. So our investments based on 1 divided by n, and n is the number of investment options offered in the portfolio. So again, we're just going to take a little bit, equal amount of everything, and this is going to actually influence our asset allocation decisions. So we actually found this, we thought, it's not we, this wasn't we. This was Bernardsey and Thaler. They wrote a paper on this back in 2001. But what we try to do is we try to bring this into a a controlled experiment or a controlled survey in order to try to see if these things are actually verified, or kind of go on our hunch to see if this is something that is widespread. But what they did here is, in order to prove this, they came up with 3 groups. And for each group, they had a stock fund, a balanced fund, and a bond fund. So that balanced fund is going to be, it's a fund that is split 50% stocks and 50% bonds. And so for group 1, they were offered a stock fund and the bond fund. So they were offered those 2 options, stock fund and bond fund. For group 2, they were offered the stock fund and the balanced fund. And for group 3, they were offered the balanced fund and the bond fund. And so you can see now, for group 1, the overall allocation range could be from 0% stocks to 100% stocks. For group 2, the range would be, even if you went all balanced, it would be 50% stocks to 100% stocks. So 0 to 100 is the range for group 1. 50 to 100 is group 2. And then for group 3, the most conservative you could be is all bonds, which is 0. Most aggressive you could be would be the balanced fund, which is 50. So 0 to 50. And we said, okay, what is the average allocation for each group? Well, for group number 1, it was 54%. Not quite down the middle, but in that ballpark. For group 2, it was 73%. So as you're seeing here, this trend, it's basically in the middle of the possible ranges. And then group 3, it's actually 35%, so a little bit higher, but still almost gravitating towards the middle. So what they were able to show here, though, is that the option menu, basically, everyone just wanted to split the 2 options. Just split the difference. Whatever's out there, I just want all the options, and I'm just going to split my money because I'm not exactly sure. And at the same time, I don't want to miss out if I get it wrong. And so we'll just split it. And what you find out here is if everyone's doing this, then their asset allocation is not in line necessarily with their risk. Only by coincidence would it be aligned with their risk preferences and time horizon. It's just a matter of what's available. So if we're planning or designing our retirement accounts, we also need to think asset allocation is the name of the game. So that's literally 90% of what investing is trying to do, trying to get your asset allocation in line with risk tolerance. So sometimes we use the old Jack Bogle Vanguard 100 minus your age, or 120 minus your age is what percent in stocks is suggested for an average investor. And so that means, what if I'm 42, so I feel like 58% in stocks is a little bit lean, but so I'm probably, if I was 120 minus 42, that would be 78, which is a little bit closer to what my asset allocation, I think I might be just a bit south in my retirement account from that. But anyway, I thought this really interesting when I found this quote. It says, "I visualized my grief if the stock market went way up and I wasn't in it, or if it went way down and I was completely in it. My intention was to minimize my future regret. So I split my contribution 50-50 between bonds and equities. Sound like you? Sound like me? I can think about that. That quote is from a man named Harry Markowitz, who was the original founder of modern portfolio theory. So he drew the efficient frontier, which capital asset pricing model was built off of. And he says, I just want to minimize my future regret, so I'm just split my contributions down the middle. Should have thought about my own portfolio theory, but I just went straight down the middle. So this is what we call naive diversification, and we need to be aware of that in our own decision-making processes, but also our clients if you're managing people's money. The next one piggybacks off of this information overload. Now, of course, we talked about wine selection, and the less selection meant more participation and more buying. And even though having larger amounts of samples made for a more pleasant experience, it led to less buying activity. Well, what we found is information overload. If you have a retirement plan that you are offering your employees, simpler is better most of the time. And we found that anywhere up to about 10 options is where you're going to receive maximum participation. So the maximum percentage of new employees starting their retirement accounts is where it's 10 options. And what you'll want to do if you're actually behind that design is knowing that not only is it 10 options, it's also this naive diversification. So you want to be really careful on which options are being provided as well, knowing that there's going to be a tendency of employees to gravitate towards that 1 divided by n in their portfolio. And so we found out that after 10 options, participation decreases, and Vanguard says that for every additional 10 options, participation decreases by 2%. So each time you add it. So the theory and the idea sounds really good. We want to provide a number of options and many, many different alternatives for our employees because each individual is different, and I totally get that. But we have to balance that benefit against the cost of these. Many people are overwhelmed when they're starting their new job. Their retirement decision is buried in a pile of paperwork that's, a little phone book thick, it seems like sometimes when you're filling out that new paperwork or going through all these electronic forms. And we often overlook that one of the most important decisions that people are going to make in their financial lives is buried in that stack of things, and we never give it adequate time and adequate support to actually assist people in this crucial decision. We talked about ambiguity aversion a couple of podcasts ago, and what we found in our investment decisions is that ambiguity leads to under-diversification. So we tend to not diversify, and the only free lunch in markets. So we talk about in markets there are no free lunches, and somebody said the only free lunch in markets is diversification or proper diversification. And that was also Harry Markowitz. So those of you keeping score, we've got 2 Harry Markowitz quotes in one podcast. You're welcome, everybody. Around this idea of ambiguity aversion and this under-diversification concept is what we call the home bias. So this is kind of built in this aversion here. The home bias is where domestic investors tend to overweight their portfolio in domestic stocks. So if you're from the US here, we're going to overweight our portfolios with U.S.-based stocks and underweight international stocks. And historically, if you look at it, these are not perfectly correlated, which also means that there's an opportunity for diversification. Now, the main goal of diversification is to either maintain the expected amount of returns while minimizing your risk. That's what diversification does. Typically, what we would find in finance is there's always a risk-reward relationship. If you want a higher return, you have to take on more risk. This whole concept of diversification just means that if you want the same reward, you can actually reduce your risk without reducing your expected return. That's the free lunch that we're talking about. So home bias is what keeps us from being truly diversified. That's our main opportunity. And even if you're from Germany, their home bias is they're going to invest mainly in German stocks, and then they might have a little more European stocks, but as the geographic map widens, it also gets to be, they're less diversified or under-diversified in that area. So some explanations around this home bias. Just think about this intuitively, where you go, why would I invest only in U.S. stocks? Why would I invest there? And if we were honest with ourselves, it more or less comes down to comfortability and familiarity. So if I'm more comfortable in what I know, then I'm going to stay invested in there. If I'm familiar with the companies and the stocks that I could own in the United States, I want to be invested in that. Now, I'm not saying, don't invest in things that you don't understand, or don't invest in things that you don't know. I'm just saying that there are similar companies or similar stocks in Japan that there are here in the United States. And that Japanese stock could conceivably provide that diversification that we're looking for. But again, we have to override our natural desire to want the familiarity and the comfort of just being in our own backyard. We could also be excessively optimistic about our own prospects and a little bit more negative about those that the prospects of other countries that we don't necessarily know that much about, especially if we have some patriotism or something like that. So, well, no, we're the best and we have to be. And so why would I invest elsewhere because they're just not as good? Well, you're going to miss out on an opportunity for diversification as well. What else here? The third one, there are some institutional restrictions depending on what you want to buy. That means like availability. But in 2023 here, there's what we called ADRs, so American Depository Receipts that you can purchase. I can go on to the New York Stock Exchange and buy Deutsche Bank. Not that I would, not that I would want to at the moment, but you could buy it. It's DB, and it's just a converted from the Xetra DAX in Frankfurt. It's just converted into U.S. dollars. You can buy it on the New York Stock Exchange. There's many international companies that you can buy here in the United States as a U.S. investor. Now, the one thing that does stand in the way is there's a marginal tax on that. So you do get international taxed. And the only reason I know that is I own a energy stock that's based in Europe that pays out a dividend. And just a little extra paperwork for my accountant when we do our taxes. But it's automatically done, and it's not an impediment enough to not be diversified internationally for opportunities, especially when there's some really good value out outside of the United States. There's always an opportunity somewhere. We just have to broaden our scope sometimes and force ourselves to look outside of the country for these opportunities. So all of this is our home bias. Now, we take home bias to the next level when we focus on overweighting our own regional stocks or even local stocks. So I'm in Indianapolis, suburbia Indianapolis, but here in my world, we hear a lot about Eli Lilly and Salesforce and some of the big companies here in downtown Indianapolis. And I'm sure they're very good companies, but we tend to overweight them in our portfolios as investors. And once again, we're putting too many eggs in this basket unnecessarily, which means if our economy is doing well, then my job will be stable and my portfolio does well. But that also means when the economy goes poorly, my stock's going to get battered and my job stability is also going to suffer. There's no diversification that's going to offset this or balance this out. And so we always want to be thinking about how can I manage or mitigate some of my risk in my own portfolio. And so I'll never forget a conversation I had with a customer during the financial crisis. And he had just lost his job. Well, I take it back. I sold like $300,000 of a short bank ETF. A short bank ETF, $300,000. And I looked at the cost basis on it, and I saw that he bought it for like $70,000 a while ago. And then the banking crisis happened, and he sold it for $300,000. I said, "How did you get into this?" And the guy told me, he said, "I was working at Bear Stearns, and I could start to see the writing on the wall, what was going to happen. And I couldn't short Bear Stearns because I work in the banking sector, but I actually could buy this ETF that was short the banking industry." He said, "So this profit that I made of $225,000 is my little nest egg as I transition into a new role." And that really stuck with me on how you can hedge some of these things just with a little bit of forethought. And so what I would always do as I watch Michigan State or any sports that I get, Michigan State football, I get pretty heavily invested in. And what I would do is they would always get a big lead and then they would blow it and break my heart time and time again. And what I ended up doing is I always said, okay, Michigan State is favored to win. And so I'll go onto the betting site, and this is really the only speculative betting I'm doing, because I already said I don't bet just for the sake of betting. I do it for either arbitrage purposes or to hedge my happiness. So what I do to hedge my happiness is I bet on the other team, the underdog, to win the game. And so I'll put up $20, and if Michigan State wins, I'm satisfied that they win. I paid my $20, that's gone. But if they lose, then I'm upset that they've lost, but I'm offset because I earned $140 on the game that they were supposed to win. So that deadened the blow, and now I can buy, I can drink my sorrows away with my $140. What people do, though, is that's not how they always bet on their own team. So they're either going to be doubly happy or they're doubly mad. And we also have this home bias with our own sports picking as well. We always overweight what our own teams are going to do or in our NCAA tournament brackets. We always say, Butler was in it. We always overpick them. And then we also overpick our conference teams that are also in these tournaments as well. I find it pretty interesting. This is all just manifestations of of this home bias. Okay. Other factors driving the home bias that keep us out, not only it's this language factor, so if something is in a different language, that's going to drive our tendency to away from that stock, and that makes sense. Cultures, so if we see a company with a different culture, that's also our tendency to drive us away from our comfort seeking. Even to the point where CEOs, if they're from a different culture, investors have a tendency of being driven away by that. We just want to be cognizant of that as well. And then there's sometimes a belief that we have, inside information on the companies that we know just because, our neighbor works in the IT department there. We just have this false belief that we maybe know a lot more about this company and are invested in it. But again, we're aligning ourselves when we should be trying to mitigate or deaden the blow and some of this exposure. All right, next thing, and I believe this is our final point. You can believe it. This is our anchoring and adjustment. So an example I use is now in real estate. And imagine if you have the same house, and this was not me again, this is just a study that was done, had the same house and then sent two groups of appraisers to come out and appraise the house. And for group one, half of the appraisers saw a listing price of $659,000. And their average appraisal was $678,110. So there's group one. List price, $659, and appraised a little bit higher at $678. Group two. Group two had the listing price that was higher, $839,000, and those appraisals came in at an average of $571,190. A difference of $73,000. So the appraisal came up, I'm going to say just over 10% higher than each group for the exact same house, and the only thing that was changed was this anchoring point, high anchor, low anchor, as depicted by this listing price. So again, we have to be careful on these anchors that are set out here. Listing prices, you're buying something online, you're buying a car, the listing price, have to do your research on this. I lied. The final thing is status quo bias. Status quo is kind of in line with our procrastination, where once we set something, we tend to leave it alone. So in our investments, that means once we set our asset allocation, we have a tendency to leave it alone. In fact, the majority of investors, so you take the median number of times that investors change their retirement over the course of their working periods, is 0. They don't change it. This is status quo. You just leave it alone, mostly led by procrastination for their whole careers. Now, this can be really dangerous, of course, that we're not changing our allocation. I'm just going to show you, and this brings us back to our exponential growth. Just another reason to use exponential growth here. But if you imagine that if you were a 22-year-old, again, I don't know what, these are my seniors in college. That's probably why I use the 22-year-old, or the fact that it would be really nice to be 22 again and not pull my hamstring when I try to run more than 80% of my maximum speed. Allocation here. If you have, let's say they start 50% stocks and 50% bonds. What we found is young investors have a tendency to invest too conservatively, and then they're too aggressive over time. So if we're 50% stocks, 50% bonds, I'm going to say we're going to 10%. I like using that. It's a nice conservative annual historic return for stocks, and we're going to say 5% for bonds. Now, if this individual doesn't touch their investments for 40 years, the way that these grow over time is your 50%, or let's just say you have, I would just throw out any number, but I said $50. So if I had $50 in stocks and $50 in bonds, it could be 50, 500, 5,000. It's not going to change the percentage, the way that these grow. I just use 50. But my stock is going to grow 1 plus 0.10 to the 40th power, because we're going to hold this for 40 years. That is going to grow to $2,262.96. My bond is going to grow 50 times 1.05 to the 40th power, and that will be $352 exactly. All right, so once again, through this, you can see that having double earnings, okay, 10 is 2 times as many as 5, see what that does over time. Has over 7 times when it grows for 40 years. So what that does, if I take my overall portfolio, is that gives me 86.5% in stocks and 13.5% in bonds. So now I've got this drift where if I don't touch it, I'm going to drift more aggressively into the stock fund that's earning more over time, when in reality, as I'm approaching retirement at the age of 62, I should be more conservative than the 86.5%. So what I tell the students is, as far as rebalancing and checking your portfolio, you've got a majority of people who don't change it at all. And then you've got some people who look at the stock market every day, and that's also potentially problematic if you get emotions linked into that. So we call this is again one of our myopias, where if you're checking your portfolio every day, you are going to experience losses between 45 and 50% of the time. Historically, each day the market goes down, which means you're going to feel a loss, and you look at if you think about your portfolio, you have $1 million in your portfolio, and market goes down 2%, you just go, oh, shit, I just lost $20,000 today. And all of a sudden, you have a couple of those, that's going to lead you to some panics, and you're going to reverse out and sit in cash because you're freaking out, and then the market goes up again. So you have these people who are very emotional, and I say, with your retirement accounts, you have a long-term time perspective. Rebalance your account once every year. You can go in every year, just take a look at what you have, kind of rebalance it to where you are in life. So once again, if I'm 42, I'm looking around 75% of my portfolio in stocks, a little bit of fixed income, and you're actually earning money now on fixed income, which is good. It hasn't always been the case for the last few years when you haven't gotten any considerable earnings, and only really downside risk to your bond portfolio. So once a year is when to do this. And I hesitate to check my retirement account for the very same reasons of not getting emotionally attached. I mean, I've got my TV behind me here, and whenever I'm working in my office, I like watching CNBC just for a little while, just to see how markets are doing, get a sense of it. But I need to detach my long-term decisions with what is going on a day-to-day basis. And just find myself right in the middle somewhere. You can watch it, but not being too attached. And so I don't check my portfolio. Typically it's I try to do once a quarter. Yeah, so once a quarter is when I go in and I've got my spreadsheet that I update net worth on. And so I try to get the updated number of net worth. And that's really the only time. And then once a year, I'll go in and see if I need to change anything from an allocation standpoint. So I'm not just, here talking hypothetically about some of these things. I'm actually working on these things myself and trying to implement some of these best practices in my own financial decision making as well, and then passing that on to you to try to do the same in your own world. So with that, if you can believe it, we are done with this section or this chapter. We have one more topic to discuss in our next podcast, and that will finish our second of 3 sections of this course. So we are plugging right along, and this is podcast number 11. I hope you're enjoying this content, and when we come back, we're going to talk about overconfidence and the ramifications of overconfidence. So something to look forward to next week. If you haven't done so, please make sure you subscribe so you can follow along with us as we continue on this journey. If you need anything from me, always reach out and find me on Instagram, brianfoltis.com, BRYANFOLTICE.com, or just hit me up on YouTube. Love to hear from you. Love to help you in any way possible. You need me to come speak, teach a class, teach your group, congregation, anything, I'm here to help as well. Spread the word about this interesting topic of behavioral finance. So with that, signing off, have a wonderful week, and we'll see you next Tuesday.